This episode of the Old Dawg's REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dawg's REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dawg's REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief Old Dawg, Bill Manassero.
Welcome to the Old Dawg's REI Network. I'm your host, Bill Manassero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dawg, spelled D-A-W-G, find our podcast, and subscribe. Well, we've got a great show for you today. I am real excited. This is kind of like the Old Dawgs meet Old Capital. So this is going to be a real old show for you guys. I've got both of the hosts of the real popular podcast for anybody that's into multifamily called Old Capital Podcast, and both Michael Becker and Paul Peebles are on call with me today. And we're going to be talking about loans for multifamilies. And if you recognize the name Michael Becker, that's because he was on episode 002 entitled How to Acquire 3,000 Units in 36 Months. He was on that podcast really talking about his multifamily and real estate investing. This time he's putting on his banker's hat, and he's going to be helping us take a look at banking and everything that you need to know as you start moving toward acquiring a large multifamily. So let me first give you a little background on each. Michael Becker, he has two roles. He's affiliated with Old Capital Lending as a senior director of mortgage origination and a principal at SPI Advisory LLC, which is the investing arm. SPI Advisory owns and manages over 3,000 apartment units in Texas. Michael heads SPI's Frisco, Texas office, where he oversees all aspects of property operations, including asset management, property management oversight, accounting, taxation, capital improvement, and renovation projects and investor relations. Mike is a 15-year veteran commercial real estate banker and has originated and managed numerous portfolios of permanent and bridge loans in all major asset classes. Over the last 5 years of his banking tenure, Michael focused exclusively on multifamily properties, where he was the number one loan producer for his division at a top 3 national lender for the last 3 consecutive years. He's a lifelong resident of North Texas and a graduate of University of North Texas with a BBA in finance. He is married and has 2 children. Paul Peebles has been arranging real estate financing for borrowers and institutional clients since 1987. As the national underwriter at Old Capital, Paul underwrites and structures all transactions handled by Old Capital through an array of sources, including conduits, banks, life companies, Fannie Mae, Freddie Mac, HUD, and private money lenders. His knowledge of the capital markets and his long-term and deep relationships with the decision makers at the various capital sources is a competitive advantage for the client. He has closed over $1 billion in real estate transactions. Paul is a deal maker. Prior to Old Capital, he was affiliated with Merrill Lynch Capital Markets, World Savings Bank, and ITT Commercial Real Estate. He is a graduate of the University of Iowa. He is originally from Western Springs, Illinois, is married, and has one daughter. Well, welcome, guys. We're really glad to have you here.
Thanks, Bill.
Thanks, Bill.
Yeah, this is exciting stuff. I feel like I'm listening here to Old Capitol, and except I get to ask questions, which is really neat.
Sure.
Yeah, this is a big area. Our audience, we have folks that are in their 50s all the way up to way past that, and some are approaching retirement and concerned, and looking to create some sort of a cash flow base for them in their retirement. They're also looking at creating a legacy for their children that they can leave. Multifamily appeal to a lot of our listeners. We have a huge contingency in California, and many of those folks are already investing in Texas. So we just wanted to take a look at just the loan process. I don't want to go into the details of it so much as take a look at what people need to be aware of as they approach this stage. You have some that may be starting out in smaller multis, and they're looking to acquire apartments that may have 100, 200, 300 units. And so I'm just going to explore that a little bit with you, and what people have to be aware of. You are the guys that look at the applicants for these loans, so your insight's going to be fantastic for our listeners. First off, I just want to kind of ask here, in looking at a prospective borrower, what are the top 3 to 5 things that you look for right off the bat? And, if you can, kind of name them in order of importance when considering a commercial loan.
Mike?
There's several factors when you're looking for a commercial loan. So let me just kind of start off first, Bill, that when most people get loans, or everyone's pretty familiar with getting like a Fannie Mae loan for a single family rental house or their homestead. And when you're going through that process, the majority of the credit decision is based off of the borrower and their ability to repay, like their income stream, so like their job or other investment income. When you're looking at a commercial real estate loan and apartment specifically, it's the opposite. The majority of the decisions first based around the property, and then kind of secondarily who is the sponsor behind the loan. So I kind of want to make sure I put that out there first. So first and foremost, what the lenders are looking for is just kind of durability of income and how they're going to get their money back. So they look at, when you buy an apartment complex, it's kind of like buying a little mini business. And so they're going to look at the income that it produces, expenses it requires to operate. And then kind of when you take your income less your expenses, you get what you call net operating income. And then they look at that compared to the amount of debt they're going to loan to you. And what they typically want is your net operating income to be about 125% of what your debt payment is going to be. So what we refer to as debt coverage ratio, or DSC, or DSCR, to use kind of jargon. So what they want is a 1.25% debt coverage ratio. So kind of first and foremost, that's what they look at. And then kind of secondarily, they look at the quality of the asset. Is there any deferred maintenance? Kind of what's your business plan? Are you going to buy this deal and it's working perfectly, and you just kind of buy it, put some loan on it, and just kind of yield, kind of what we call a yield play? Or is this more like a value play where the property is a little bit more distressed, has some deferred maintenance, and you're going to come in and put some capital into the property, upgrade the units to cure any deferred maintenance, raise the rental rates up, and by extension try to raise the value. And then finally, what they look at is kind of who is the sponsor behind it and the sponsorship team, and what kind of net worth and liquidity they have going into the deal, and what it's going to look like after they close on the loan, as well as their track record and experience. So those are kind of the things when we're assessing a potential loan transaction, is like, well, how do we put the pieces of the puzzle together? And those are the main things that we look at. Yeah,
and if you don't have multifamily experience in the past, because you've never bought a 10 or a 15 or a 200 unit apartment building, I don't think I have too much of a problem. But going back to Michael's third point, 2 big things I look for on the lending side is liquidity, how much cash that you have in liquidity. That's not IRAs or 401ks, but liquidity, stocks, bonds, cash that's in your name solely. And I'm also looking for net worth, just like Michael said. I'm looking for assets versus liabilities. Exactly what do you have for a net worth? And probably the biggest thing is, like Michael said too, is what's your pro forma look like? What's your game plan? What's your business plan? What are you going to do with this asset? How are you going to improve it? What are the things that you're going to have to cure that's been deficient on the property? Is it a management play that just needs to be turned? Which we do have some properties that need new fresh blood management on the property, or is it just a different clientele base because the property has been misguided. The money hasn't been thrown at it. As people listen to our podcast, I'm a big believer in putting money back into the property. Do not use it as an ATM machine solely. Just can't continue to take money out of the deal and put it in your pocket. You got to put money back into the property itself. These properties are like bodies. They have to continue to be fed all the time by putting new capital improvements to the property. So what's your game plan from today, 6 months from now, a year from now? What are you going to put your money into the property? We're a big believer in putting, if it is a rehab property, putting the money up front into fixing these deferred maintenance, or putting in new interiors, or updating the exterior of the property, maybe putting some amenities into the property. Don't do it out of cash flow. That is not a good idea. Put the best product at the best price on the street up front. You get the best client, which is your tenants on the property. Make sure that you put good management in. And we're also a big believer. You could manage the asset yourself, but we're also a big believer in having a third-party property management company to oversee the property. And these properties that maybe 25 or 30 or 40 units, that's already a line item of expense that we already factor in a property management company. So that's already added into the expenses. It's not something that you think you're losing money by having a property management company in there. It's already added into the expense structure of how the property is run.
Great. And you mentioned the loan as far as improvements and upgrades. Let's say it is a value add deal. Your loan would typically include the construction and rehab amounts necessary?
Yeah, typically we can. So whether it's a bank transaction or possibly a Fannie Mae transaction, but if it's a bank transaction, we typically will take the acquisition price, so whatever that is, and we add the rehab dollars into it. So if it's a $900,000 acquisition price, and it's $100,000 worth of rehab to improve the property, new paint scheme, new fixtures in the property, new parking lot, new vinyl plank flooring on the property, $100,000. So our all-in price is $1 million on that. And we'll typically, if this is your first deal or two, we'll probably do it 75% leverage, 70 to 75% leverage in the deal. So you'd be looking to put down 25 to 30%. But we're going to include that rehab piece into the transaction. Any more to add to that, Mike?
No, I think that pretty much covers it.
For clarification for our listeners too, when you say whether it's a bank or a Fannie Mae transaction, just clarify what that means.
Mike?
Yeah, so like I mentioned when I started out, Fannie Mae is, Fannie Mae and Freddie Mac are not only the largest lenders for single-family homes, they're also the largest lender in the multifamily space as well. So they'll loan money on properties, but what they look for are stabilized properties to experienced borrowers, people with previous multifamily ownership experience. So as if you have a property that's kind of broken, that needs a lot of renovations or isn't stabilized, maybe you're like 80% occupancy and the market overall is 95% occupancy, and there's a management issue or physical issue you got to cure. Those types of products, those types of properties typically require like a bank loan, which would be like your regional banks, your community bank loans, and then the stabilized properties that are clean and working well to experienced principals primarily go into the Fannie Mae Freddie Mac pool.
You also mentioned, both of you, the net worth aspect. And are you looking at one person on that team, or the borrower or a sponsor? Do you look at combined net worth of individuals? Let's say you're going to purchase a building for $5 million. What kind of net worth would you want from that individual or combination of individuals?
So generally speaking, most of these larger apartment buildings are bought by syndication, which I believe you spoke about on previous episodes. But what syndication means is, say when I go out and buy a property, Bill, I'm the lead in the deal or sponsor the deal, and so I'll go out and secure the property, identify it, secure it, get it tied up, get it under contract, and then I'll go out and syndicate my equity, which means I'm going to go out to my friends and family and try to raise capital. $100,000 at a time. So if I need $1 million, I'll get myself and 9 of my friends, we each put in $100,000, and then we have, our $1 million to go buy the deal. And so when you're looking at, when the banks are looking at the loans, they typically want, the KP or key principals, what is a Fannie Mae term, or on the bank side is called a loan guarantor, to have net worth equal to or greater than the loan amount. So if I have a $4 million loan, I need $4 million net worth. So if I don't have that all on my own, I could go get you and Paul, and we collectively together, as long as in aggregate we have that $4 million net worth, the bank is comfortable with it. So you don't have to have all the resources yourself to do these deals. Most people, simply, you just can't buy, these large deals on your own. Most people just don't have that kind of net worth. So it's a group effort. It's a team sport, as we like to say. So it's definitely in aggregate.
It's good to know. That's great. So you put much weight on comparative sales of other similar sized properties in the area?
No.
Oh, that's good. That's a good straight answer.
In single family lending, like when you bought your house, we use comparative market analysis on that one. So a 3-bedroom home with a 2-bath in around your neighborhood, that's a comparative market analysis. If it's worth $400,000, your neighbor's house, your property may be worth $400,000 if the whole neighborhood is selling for $400,000. In the multifamily space, we don't look at it so much with the sales prices. We use kind of what's called the income approach. The income approach is based on the net operating income of the property. So what we do is we take, I'm going to get a little technical here. We take the operating income, which is your rents, any form of rents, whether it is administrative rents, utility bill backs, vending machines, laundry machines, anything that comes into operating income. We subtract out the operating expenses, whether it is property taxes and insurance, repairs and maintenance, and a list of about 5 or 6 10 different things, line items for expenses that keep this property going. And that we subtract the income versus the expenses, then I have a net operating income. And it's that net operating income determines pretty much what the value is of the property. And then we do a comparison, what's called a cap rate. And the cap rate is determined by the market itself. It's determined by appraisers. It's determined by sales in the area of what similar properties of age and amenity structure have sold for in that area. That's how we develop a cap rate. And then based on the cap rate and that NOI, that equates out to a value. And that's really where we come with the value. So the way we formulate valuation on an apartment complex is different from single family. That's one thing that you have to kind of communicate to your ownership groups, is that it's not the same. But NOI is the most important thing. So if we can increase the NOI up by saying $10, they'll have a direct impact to the bottom line of the valuation of the property. Anything more to add to that, Mike?
No, I think you did a good job.
The formula for valuation is, with the factors you gave, NOI and cap rate, how would somebody calculate that on their own?
It's simply just taking the, like Paul said, you take your operating income minus your operating expenses like property taxes, payroll, repairs and maintenance, et cetera, which excludes your debt service payments. So it doesn't have interest expense. So just your income less your operating expenses to get your net operating income, or NOI. You take that divided by your capitalization rate, or also referred to as cap rate. So if you have, for example, if you have $300,000 in net operating income and you have $200,000 in operating expenses, operating expenses, you get your net operating income of $100,000. And if it's a 10 cap, or you divide it by 0.1 or 10%, so 100,000 divided by 0.1 would equal $1 million. So if you want an unleveraged return of 10%, and it produced a net operating income of $100,000, someone would be willing to pay $1 million for that property, if that makes sense.
That does. And just to clarify on the cap rate, is it the cap rate of that area? In other words, what other properties are selling? What's the cap rate of other properties, or is it the cap rate of that particular property?
Yeah, so the cap rate's driven, like Paul mentioned, it's driven by the market. So
okay, so it's a market.
Whatever the other similar properties in the market of similar locations and similar vintage, that is what sets kind of the market cap rate.
Gotcha. Great.
So we're in the center of the universe when it comes to apartments in Texas, and especially Dallas-Fort Worth, where we're physically located at. And so cap rates in this marketplace, depending on the age of the asset itself and the amenities of the property and the condition of the asset, may be anywhere from 7 or so down to, if it's a nicer, newer property that's just coming to be built, is it probably a five cap. Where, let's say in California, we probably start off at a 5 or a 5.5 or 6, and then get all the way down to say a 3.5. What you have is you get a bigger bang for your buck in Texas than you would in, say, Southern California or even the Bay Area for similar conditions, similar age property on the deal. And that's why we have so many investors coming to Texas, just because of, say, jobs and the amount of properties that are available to purchase in the state of Texas.
Now, I've heard of people, getting cap rates of like 10% in Texas. Are those maybe lesser, maybe Class C type buildings or in less desirable areas?
Yeah, those days are probably long gone. They used to be available. I just use a 10 because it's easy to do the math, and I'm not that smart. So you just divide it by 10, and it's pretty simple.
Right.
But yeah, anything I think pretty much across the country that would have a 10 cap today. Likely one is not truly a 10 cap. They're either they're most likely understating expenses or leaving something out of the operating expenses. Like, say it's a small property and the guy runs it himself and he fancies himself a handyman, so he doesn't charge for his own time to go change out a garbage disposal or mow his own grass. But when you go sell in the open market, the next buyer would factor that expense in their operating pro forma expenses. So that's one common thing. Or two, it could be in the hood. Those would be the two likely things. And buying properties in the hood is the surest way to get your clock cleaned. That in my experience.
Mike, talk about ways of getting your clock clean. Last time we had problems in your apartment business, what were some of the reasons why we got our clocks cleaned as investors?
Sure. Yeah, being a banker through the last recession, there's 3 or 4 kind of common themes that I noticed would cause people to have issues and lose properties. One, like I mentioned, is you buy a property in a high crime area, kind of buying the hood. That's hard. Those are the properties that are the lower socioeconomic areas. So when you have economic problems, those are the areas that get hit the worst, unfortunately. 2 would be having not putting capital into the deal up front, meaning that, like Paul mentioned, we're big believers of putting the money up front. When you buy the property, put aside an escrow account, cure the issues right out of the gate versus doing it in cash flow. So what happens when you hit kind of a soft patch, sometimes your rent's softened or you have to offer like a half a month or 3 months worth of rent, kind of what we call rent concessions. And if you don't have the money set aside for something, and in Texas it gets hot, so if you have like an occupied unit that has its AC condenser go out, you go take a working condenser from a vacant unit, put it on your occupied unit, and now your vacant unit doesn't have an AC condenser and can't be rented. And then it kind of snowballs on you. So not having capital set aside on the front end is an issue. Another one was poor management. So like Paul mentioned, like we had a lot of, or you mentioned, Bill, we had a lot of people from California come to Texas. So, I can give you stories of UPS drivers that had a family house in Los Angeles that sold it and took $1 million out and bought a small apartment complex in Texas back in 2006 or 7. Thought he could manage it from California remotely, and having poor management, not being on top of it, that caused issues. And then finally, just people having maturities at bad times. So we're big believers of putting today still relatively low interest rates, putting long-term fixed rate debt on loans and setting it out 7, 10, 12 years out. So when if you have a dip in the cycle, you have many years left on your loan to kind of ride it out. If you happen to have a maturity, say in 2009, and the capital markets were frozen, and your values had gone down, then the bankers to refinance your loan would ask you to do a capital call, put more money in to lower the leverage of the loan. And a lot of people just couldn't do it at that time because everything was hitting them. So the people that had long-term fixed rate loans that had maturities out past 2009 certainly were able to weather the storm a whole lot better than the ones that took floating rate loans that had short call maturity dates on them.
Yeah. What would you say now to a person that is, let's say they've got a number of small multi-properties, maybe duplexes, fourplexes, maybe 8 units or something, and they really want to get in the 100+ units. For somebody like that's looking to get into that marketplace, what do they need to have in place, and what would your recommendations be to that person to move into that level of asset?
I would think is like I said before, real estate's like a team sport, so you need to kind of build your team out. When you go buy a duplex or a single family house, a duplex, a fourplex, usually the broker on the other side of the transaction, the listing agent, doesn't care if you have previous ownership experience. If you're going to go out and try to buy a 100-unit apartment complex, they're not even going to show you the deal unless they understand who you are, how you found it, and try to assess your credibility out of the gate. This is an unfair business, unfortunately, and a lot of it is who you know and who's your team and what kind of credibility you have. So first and foremost, you need to start getting a team put together. You need to get educated. So if you don't have previous ownership experience in large apartment complexes, you need there's many resources out there where you can go and learn how to do this. Different groups can teach you how to do that. That way, then secondarily, you need to make sure you talk to a mortgage broker. Old Capital, obviously, we do a lot of business, or one of our competitors that's competent in your area, and make sure that they assess your financeability, because that's just certainly one of the questions any listing agent's going to ask is, how are you going to finance it? Where's your money coming from? Where's your equity, and where's your debt? Those are the two questions that you need to have answers for. And then finally, make sure that you interview a good management team, third-party management team. They also that are based in your local area where you're looking to buy. They also will give you credibility that when you talk to the broker, that so-and-so from my management company has seen this deal and they manage a property a half a mile away. Those are good things to give you credibility with any listing agent.
That transfer of credibility is a key component if you're moving from single family 1 to 4 unit properties up to 50 to 100 doors. Transfer of credibility, if you don't have it, you have to get it. Michael mentioned education. That's probably my number one thing, is getting out there and getting educated. Pay for a mentor that actually is a hands-on mentor, because you can make a $50,000 mistake in a blink of an eye, just like finding the wrong asset in the wrong area, putting the wrong improvements to the property. Listen to somebody that's actually been there, done that. Have them prove up their educational system, what they've done for other people. Listen and talk to those other people. But putting together your team, whether it is your attorney or your management company, or any part of the group, that's an important piece, because what we're looking for also is when you identify a property and you want to go forward on the deal, and you have maybe an accepted letter of intent in working your way to a purchase sale contract, we want you to make sure that you do a real good, thorough job, and having somebody do the physical due diligence on the property, which we want somebody to take a look at the property, as your eyes and ears, that they have a certain skill set, whether it is putting camera down the sewer line pipes to make sure there's no broken lines, or making sure the electrical system doesn't have any issues with overcapacity for everyone plugging their iPhones and their stereos and everything into the walls these days, based on properties that were built in the 60s and 70s, making sure they can carry that load capacity, making sure the roof has been reviewed, the parking lot's been done, making sure that everything, the physical due diligence, has been eyeballed. So you know exactly what you're getting into, what you're buying. and a person who does engineering or is a person who does single family is not a multifamily specialist. So you seek out a multifamily specialist. That's a key person on your team that is going to play a critical role to kind of determine what the costs are going to be up front to have us put that into the loan so you can cure those immediate needs on the property.
Great stuff. When you mentioned the education part of it, give us an idea of educational organizations might be.
In our area, there's two groups that we thoroughly recommend, and they've been doing it for a long period of time. One is a group it's based out of Houston, has operations in Austin, San Antonio, and Dallas, but they're a national platform. They do I think a daily radio show called Lifestyles Unlimited. There's probably 20,000 members of that. They do a great educational mentoring job. The other group is called Brad Sumrock. I think it's under bradsumrock.com. He's a Carnegie Mellon guy. He's on thousands of apartments in the past. He's a great teacher mentor, and he offers a platform that he'll teach you from the alpha to the omega what needs to be done and how to avoid mistakes. He doesn't buy it with you, but he's just his passion is in teaching, and you can look those two companies up on the internet. But they are great sources for education. And we do a lot of business with them too, so I'll put that out there too. So we do like those two companies, but there's other companies around. There's real estate investment clubs in specific areas that you want to get involved in. Other things you want to take a look at is maybe go to meetups in your local area. Meetup, and it's kind of where people with similar ideas and attitudes want to get together and talk a little bit about whether it's rock climbing or square dancing, but there's ones for even commercial real estate, and try to feed off of that and try to build a little bit maybe your team in that one. So we like meetups too.
Can you give an example of a situation where a loan applicant comes into you and really within the first 5 minutes, and again, I'm giving maybe an ideal situation here. You know that this person is going to be a great candidate for a loan, and in their presentation and what they provide to you. Have you had those types of situations before?
Yeah, we can size somebody up fairly quickly just based on their personal financial statement and what they know. We're not looking for. We have no problems teaching people and telling them a little bit about how these transactions are structured. And so we like to have them have a little bit of basic knowledge before they come to see us or so. So we'll talk a little bit about what we can do at the end of this program. But, we definitely like to see a strong personal financial statement with net worth and liquidity and kind of your game plan, and then figuring out a little bit about who your team members are going to be to try to take down an opportunity that you've uncovered.
Mike, did you have anything similar?
No, yeah, it's a lot of it's about your financial statement and how your team is set up, and if you don't have that, that's one of the value add propositions that we try to do to people that come to us that maybe only have part of the equation put together, and then we can hopefully, if it's in markets that we serve, that we can hopefully help you get management company and or the bank or insurance or whatever would be, or introduce you to some of the listing agents in our markets that we know pretty well. Those are some of the things that we can kind of help put the pieces of the puzzle together.
We're going to find out what your level of knowledge is. If you're in duplexes or fourplexes, you're looking to make the jump up to 10, 15, 20 units. We got to understand the backstory. First of all, why you want to do this? What type of timing do you have? Do you want to try to do it yourself? Is this property? Do you live in Southern California and you're looking to make an investment in Norman, Oklahoma? Why are you doing that? Where's your information on that area coming from? Have you been to the property? Tell us a little bit more about. Go into a little bit more detail, not just because you saw it on LoopNet that it had a 10 cap to it, and you want to invest in 10 caps. I want to hear the full story of what's going on.
Sure. And what percentage of your applicants do you actually see? Or do you do most everything, online and via the phone?
We see probably about 99% of them because we want them to. We want to build a relationship with them first. We want to, know the client is probably the biggest thing. We will do transactions where people that we've never seen or met before, but we want to make sure that they actually physically walk the property. We'll probably walk the property with them. If it's in an area that we can maybe jump on an airplane, go take a look at a property with them, we'd be more than happy to do that. We'd rather do all this hard work up front in the deal than come back and say, well, did you drive the property? Did you go into detail with the client? Well, 3 to 6 weeks down the road, and we have a problem. So we'd rather spend time, meet the client, be the property, talk with the management company, put the transaction together with the pro formas. And it's not necessary for us to physically meet you, but, like anything, you want to know who your banker is. You want to kind of understand who your client is. You want to know who where the property is located at. We want to know the backstory of the transaction.
Looking at the current market with the increasing interest rates, I know there's been a bump, since Trump got elected. Do you see that trend continuing? It almost seems like it's been held back for a number of years. And what's your opinion on that, and where it may be going?
Where it's going, I have no idea. That's always the tough part about the business. It's it's completely out of everyone's control, but it does have material impacts on loans along the way. Not only does it increase the cost to borrow. Some of these loans, when you're sizing them on, like say a Fannie Mae loan in particular, a lot of these loans are doing like 12-year loans. If your interest rate goes up, your cost of debt payment, your debt service payments go up, and then if your ratios get out of whack, the way the lenders cure the ratios is by cutting loan proceeds. So we've had right now we sit the first part of December. We've had transactions that we started, early November, and then that was before Trump, before the election, and then now we're dealing a little bit with the aftermath, where some of the rising debt service payments are cutting back some loan proceeds. So right now, as we talk, it's a little challenging as we currently sit, because there's a little bit of uncertainty. I would imagine we get some level of certainty after he's sworn in and we kind of calm down. But I don't know. I don't know if we're this is a temporary spike and it'll come back down, or we're going to keep running. That's a good question. I don't have an answer for.
And Fannie Mae loans are marked to the market, which means that we don't only lock the interest rate in until the loan has been committed, and that's probably after 5 or 6 weeks after the loan has been processed, underwritten, appraised, and all the things that third parties are going to do. So Mike is correct. And so what happens is that right here at the end is that we're about to try to rate lock deals, and interest rates have spiked up like 65 or 70 basis points from the day that an application was taken. That could have a material impact on the loan dollars. Now, on the reverse side, on the banking side, because those loans are based on deposit rates, that interest rate spike doesn't move through the market that quickly. It's kind of the pig going through the python, so to speak. That's a very slow process. So we'll see interest rates rise on the bank side, but we may not see them for, 60 days, 90 days or so. So interest rates that were available back in, say, October are still going to be available in November, December. So that's a real slow process. So, it's who knows what's going to happen? I really don't know.
Any, putting on your economist hat here, any projection on how the Trump presidency will impact the commercial real estate market in general?
Interest rates will affect the market. So to the extent that he affects interest rates and rates go up, we were discussing internally, a bunch about, a few months ago about what the potential move in interest rate would be. And at the time, I thought we have it about 75 to 100 basis points, or, 3/4 of a point to a full point. And an increase that we can sustain in the 10-year Treasury, which is how most of these loans are priced off of, before we see any material move upwards in cap rates. But we pretty much have taken the vast majority of that out, in my estimation. So I think if we continue to go up from this point, like we said, we're interviewing. You said doing this interview right now, the first day of December 2016. So if we continue to see rates go up, we'll have to at some point see the cap rates also go up, which basically in layman's terms means that pricing will go down. So the prices of these will go down. What I think is going to happen before that actually happens is, I'm an owner of real estate. If I have it on the market to sell, and a month ago I could have got $1 million for my property, and now the rates are up, and the buyer's like, man, I don't get my same return because my interest rates are up versus what it was a month ago. They're just not going to pay my price. They're only going to pay $900,000 for my property, and I'm not going to sell because I think it's worth $1 million. So there's going to be a time where I think the transaction volume will have to like slow up until we have some level of price discovery in the market, and the sellers realize, okay, everything's changed, and that was then, and now is now, and that's not a easy flip of the switch thing. It takes a series of no's and disappointments for the owners when they're trying to sell it before they actually realize and discover that the pricing has moved. So how quick that goes, I don't know, and if the rates drop right back down, then, it could just be kind of business as usual as we had it, but it's gonna be interesting. One thing the markets don't like is volatility. So if we continue to have some level of volatility, I think it will slow up the overall transactions in 2017 compared to 2016.
Do you only lend in Texas?
No, we lend throughout most of the United States, but commercial lending is almost like tribal knowledge. We have deep relationships, great knowledge in Texas, throughout the state of Texas, but we also lend in Arizona, Nevada, Oklahoma, all throughout the Southwest, in Florida and in other states. So don't give us a call if there's something that we can help you with. At least we'll give you our advice.
Great.
I've done this for 33 years, and I've closed 4,000 loans. I mean, it doesn't hurt to just give us a call, and we can kind of lead you down the path if it makes sense or not.
That's great. A lot of people listening are obviously interested in Texas. Just wanted to find out from you guys. You're doing the loans. You're obviously very involved in the markets. Are there certain areas of Texas you're pretty excited about right now? I know that. Michael, you're an investor, so you're obviously looking at those hot places to go, and maybe even those hidden gems regions. And are there any still out there? I mean, there's still a lot of activity going on in Texas, but are there certain areas that look real promising?
Yeah, there's kind of a tale of two cities, but I guess we really have four major cities here. There's the four major metros in Texas are DFW, where Paul and I are based, Dallas-Fort Worth. You have Austin, San Antonio, and Houston, and they're very different markets. And what a lot of people headlines think of Texas, you think of oil. That really affects Houston. So Houston's had some economic issues over the last 2+ years now with the decline in the oil prices. So they've really they're blowing a go on building a bunch of units, and that's all the new stuff is kind of stopped. They're finishing it out, and they're offering rental concessions on the multifamily products, and their office market's a mess, because they had a lot of oil jobs. So Houston's in a little bit of flux right now. San Antonio is kind of a slow plodding market. It's always just been kind of slow and steady with gradual growth. It seems to be that way. They have a lot of large corporate offices there, and they have a big military base, big military presence in San Antonio. So it's a pretty stable, kind of plodding, boring market. But, we do a lot of business in San Antonio, and it's a pretty good market down there. Austin's been the high flyer. It's kind of like a little mini California and Texas. Right there, they have a lot of growth. The population just absolutely exploded over the last decade or so, and they have a lot of tech jobs. It's a much more liberal place. It's kind of a liberal part of Texas is right there in the heart of Austin. And then Dallas-Fort Worth, which we're based, is the largest metro area in the state, the fourth largest in the country, I believe. And we have about 7.2 million people. Very diverse economy. We have all these large Fortune 500 corporations headquartered here. We're constantly getting all these big corporate reloads from your backyard, Bill, from California. The big headline over the last couple of years has been Toyota's moving the U.S. headquarters from Torrance to Plano, Texas, which is about a mile or two from where I office, actually. And they're moving 6,000 jobs with it. And if we can tell you story after story about big corporate relocations from California to DFW. But we don't have any one industry here. So all the markets markets in Texas. Obviously, I'm biased because I live here, but it's very diverse. It's got growth. You can still get decent values to income relative to the prices. So the yields on the properties are still great. The entire state has no state income tax, which is a huge advantage over states like California with 13% top tier for state income tax out in California. So there's a lot to like about the state, but definitely the areas that are concentrated in the oil, which is primary Houston, and then you got Midland, Odessa out in West Texas. Those areas are suffering, and the rest of the state is doing pretty well.
What about the sub-markets, towns like Waco or Lubbock? Are there any little sub-markets that are...
secondary markets?
Yeah, the secondary markets kind of sound...
the secondary markets are definitely there. I don't know if Paul has opinion on some. We do some business. We obviously loan in the secondary and tertiary type markets. There's just not as much supply there. There's just not that many people that live there, so there's not that many buildings. And then you're a little bit more susceptible to any one company leaves a small town, you're a little bit more susceptible to have a downturn in that area. So they tend not to be as attractive, in particular for out-of-state investors, just because out-of-state investors want know of these major markets, and the durability of the income streams is a little bit more guaranteed in a major market because you have a lot of diversity. But Paul, do you have any thoughts on secondary markets?
I definitely like secondary and tertiary markets. Gets out a little bit out of the mainstream with a lot of investors say I only want to lend or invest in Dallas or Austin, and they always forget about the secondary markets. The one thing to just remember is the properties that we're lending on. We do more apartment loans than any apartment lender in the Southwest. These are properties that are as old or older than your demographic. These were built in the 50s, 60s, 70s, 80s, and 90s. We're not lending on institutional Class A properties. That's not what investors that are buying these days. The REITs are buying that type of stuff, but the individual or small family offices or the small syndications, they're buying properties that were built in the 60s and 70s with the value upside too. So now these are older properties that have to be cured, fixed up, and stabilized.
Great. Yeah, I know a lot of people here are very interested in the North Metro area, and some of those maybe secondary, tertiary markets up there seem to be real appealing to. I think I could talk to you guys all day. This has been really fascinating, but I've got to respect your time and let you guys go. One thing I want to mention here is that I've received this information. There's it's called the Fundamentals of Multifamily Financing, and it's about a 15-page document. I would rename it myself Multifamily Loan Cheat Sheet, because there's so much information in here for somebody that's ever thinking of applying for a loan. Everything. You could think of. It's a great document, and I understand you guys are going to make this available to those that want the information. It goes into. Not only does it talk about just a general overview of the multifamily market, but it goes into real specifics about what you need to have when you go in for a loan application, what they're looking for. It's just a great piece. But I understand you're going to make that available to our listeners. Is that correct?
That's right. Yeah. If anyone is interested in learning a little bit more about apartment financing and how these deals get done, if you just send an email to info@oldcapitallending.com, that's info@oldcapitallending.com. We'll reply back with the what we call our white paper, our 15-page report. It kind of goes through the basic nuts and bolts of how do these loans get done, and like Bill said, a little update on the market as well. And then we can also add you to we have a weekly email that we send out that has tombstones on some recent deals we've done and links to our podcast. That's another good resource if anyone is interested in this. I like to kind of describe it. We have a podcast for apartment nerds. So if you're into commercial real estate and investing and things like that, the Old Capital Real Estate Investing Podcast is on iTunes and Stitcher and Google Play. So if you just kind of put in Old Capital when you search for it, it'll be there, or you go to our website at oldcapitalpodcast.com. It's on there as well. We try to do weekly podcasts where we interview both vendors in the marketplace like brokers, management companies, et cetera. And then we have a lot of our clients on and kind of talk about the transactions that they've done, the success stories, and kind of talk about general market updates all the time. So definitely, if you're interested in learning a little bit more and you like commercial real estate and apartment investing specifically, the Old Capital podcast has a lot of good content around that.
I'm a subscriber too. I can vouch for that. I particularly like the testimonials of the folks that have purchased apartments, and I mean, you really go into some great detail there. They'll share their journeys as well, and some of them are new buyers, and it gives you almost like the small town banker feel. You put people together and you connect people too. There's a lot of neat aspects of Old Capital that I would really recommend people listening to. I'm a big fan of your show. So
that was the brainchild of Michael Becker.
Well, as if you guys don't have enough to do already, right? Gosh, this has been really great. The website, you guys would have all that information there, or is there a number?
Yeah, our website's oldcapitallending.com, oldcapitallending.com, or the other one's oldcapitalpodcast.com, and then I'll give you our main number, which is 817-488-0440, and that's where Paul's located. So if anyone has any questions, certainly just reach out to us, and we're happy to talk about it. And if we can't help you specifically, we'll at least give you a little bit of advice and try to point you in the right direction.
Oh, that's great. Well, thank you so much, you guys. We have a tradition here, as Michael already knows, that we ask our guests to close out with their best old hound dog howl. Now, I know if you're from Texas, you guys know hound dogs. So if you guys, I've never had two guys, howl at the same time. So this is going to be a classic here, and it'll be going to posterity here as one of our classic shows. So if you guys are ready, I'm going to just say 1, 2, 3, and then howl. Are you guys ready?
Let's go for it.
Yeah.
All right. 1, 2, 3. That was great. Thanks, guys. Oh, man. Well, we really, really appreciate your coming on. This has been great. Like I said, I'm a fan of your show, but you guys don't always get to talk. People don't ask you questions. You're asking your guest questions, so it's really nice to be on this side. Also, want to thank all of our Old Dog listeners out there for joining us today. I know there's a lot of things you could be doing right now, but the fact that you've taken the time to listen means a lot to us, and we greatly appreciate it. Paul and Michael, thank you so much, and we'll be listening to your show, and I hope those guys will be sending emails and getting that white paper from you too. I think that's a great thing to offer. Well, that's a show for today. Remember, cash flow is king, and real estate investing the means. Until next time, keep moving forward, and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.